A warm greeting by my side. In this module, we are going to see about RBI's credit policy, which is in Unit 7 in the net commerce syllabus. The contents what we are going to see in this module is credit policy, what are all the objectives of credit policy, what are all the instruments in RBI's credit policy, followed by a current affair, which is RBI's credit policy in 2026. First, what is credit policy? It is an important tool in monetary policy. It controls the demand and supply of money, and it also controls the flow of credit in the economy. RBI control over the credit created by the commercial banks, and it is also act as a banker's bank and lender of the last resort. Next is the objectives of credit policy. It stabilizes the price in an economy, and it also stabilizes the exchange rate in an economy. It creates and it generating employment opportunities, thereby it also accelerating the economy growth. What are the instruments of credit policy? We are having two measures in the credit policy. One is quantitative measures, other one is qualitative measures. In that, first topic is reserve ratio. In that, we are having cash reserve ratio. What is cash reserve ratio? The central bank controls credit by changing the cash reserve ratio. For example, if the commercial banks have excessive cash reserves on the basis of which they are creating too much credit, this will be harmful for the larger interest of the economy. So, it will reduce the cash reserve ratio which the commercial banks are required to maintain with the central bank. The current cash reserve ratio is 3%. Next is statutory liquidity ratio. It is the amount which a bank has to maintain in the form of cash, gold or other securities. The current statutory liquidity ratio is 18%. Followed by there is open market operations and quantitative measures. What is open market operations? In the narrow sense, the central bank starts the purchase and sale of government securities in the money market. Next one is policy rate. In that we are having bank rate, repo rate, reverse repo rate and marginal standing facility. First, what is bank rate? The bank rate is the rate at which the central bank of a country is prepared to rediscount the first class securities. For example, if the central bank wants to control credit, it will raise the bank rate. As a result, the deposit rate and other lending rates in the money market will go up. Borrowing will be discouraged and will lead to contraction of credit and vice versa. Next one is repo rate. What is repo rate? It is the lending rate. It is the rate fixed by the RBI to lend to commercial banks. The current repo rate is 5.50%. Next one is reverse repo rate. It is a rate which is also fixed by the RBI to lend from commercial banks. The current reverse repo rate is 3.35%. Last one is marginal standing facility. Next, followed by qualitative measures. We are having rationing of credit, which is nothing but credit rationing. This is the oldest method. It aims to control and regulate the purposes for which credit is granted by commercial banks. Next one is consumer credit control. The down payment is raised and the number of installments reduced for the credit sale. Next is margin requirements. What is margin requirements? Is a minimum margin requirements needed by the RBI from other commercial banks. Next one is moral suasion. This method is frequently adopted by the central bank to exercise control over other commercial banks. What is direct action? It is an action taken by the central bank when the commercial bank is needed something. Last one is credit policy of 2026. The RBI hikes interest rate, projects 5.25% economic growth for the financial year 2025 to 26. RBI hikes benchmark repo rate by 25 basis points to 6.50%. Marginal standing facility rate will stand revised at 6.75%. Thank you.